The CPI reports came out today and it was bad on every factor, crashing the markets. It was totally devastating, blood in the streets, arms and limbs flying everywhere, but it had a surprising turnaround. And in this video, we're gonna cover all that and what you and I need to know so that we do not get wrecked. And stay till the end so you don't miss out on the important dates to be aware of and the predictions coming from them. The CPI reports coming in October 13th, 2022 at 8.2%. It was forecasted at 8.1. That is an increase to the upside by 0.1%. And core CPI came in at 6.6%. The forecast was 6.5%, 0.1 higher than was expected as well. From month to month came in at 0.4% CPI, 0.2% higher than expectation, and core CPI came in at 0.6%, 0.2% over the expectation, which was 0.4. So what we could surmise out of this is that inflation is slowing down, but not as fast as the market wants or expects it to be. And when something happens, when the market fails to predict it, you could expect extreme volatility. Okay, just so we're on the same page here, some quick definitions. The CPI, the Consumer Price Index, it measures the average change over time in prices paid in a market basket of goods. And the basket of goods, the range of items it covers are things like food, transportation, housing, energy, education, medical care, and recreation. However, some of these items are quite volatile, like energy and food, and we call that core CPI. So core CPI removes food and energy because they are so volatile. And this is a chart showing you the difference between headline CPI, which is the regular CPI, and core CPI, which is the CPI minus food and energy. So this dark red line is the headline CPI. This is the inflation report, and you could see how volatile it is with this. But if we put in all items less food and energy, which is core CPI, you could see just how stable and how muted it is compared to the headline CPI. You could see, look how flat that is and less volatile versus look how volatile that is. That's all items. And this is why the Fed likes to look at core rather than headline, because they feel like this is a more accurate representation of inflation. Now, whether or not you and I disagree or agree with how they measure, well, that's regardless. We're small fish, okay? They're the big whale shark here. They don't care how we consider measuring inflation. They're the Fed. Okay, let's talk about Bitcoin, because Bitcoin had some big moves today. As you can see on the left here, the chart, this is the chart running up to the CPI numbers. It hasn't released yet, but then all of a sudden you see the release of the big chart, boom. Boom, that is the results of the CPI report coming out. What 2022 has taught me is that if I'm trading in crypto, I need to be acutely aware of the macro, of what is happening outside of crypto in the bigger space of the macroeconomic environment. You and I have to move away from astrology and technical analysis and moon boy math, because I want to see you with heavy bags and the ability to buy in with amazing projects at cheaper discounted rates. And one of the best ways to do that is that you and I together understand the macroeconomic environment of what's happening. And so the question is, how is the Fed going to respond to high inflation? There's only one of two ways: a soft landing and a hard landing. A soft landing is basically easing the economy down so that there is no recession and it's a gradual decline in growth. A hard landing, however, is a sharp downturn in the economy where they crash the markets, crash the economy, and bring us into a recession. And maybe you could think about it like this. Imagine me tossing up a kid up in the air, and I could bring that child and catch the child and bring his supple, soft body all the way down to the floor, or I could just let that baby drop on the floor. You and I are that baby, and the Fed is our papa. I want to hear from someone smarter than me. His name is Stanley Druckenmiller, and he's an American investor and hedge fund manager, and he talks about whether or not he thinks the Fed will give us a soft landing or a hard landing.
You're so far behind the inflation rate, and there's so much wood to chop, and there's been such a broad asset bubble going into it. It's very hard for me to say that the probabilities favor a soft landing. Indeed, I think they aggressively point to a hard landing. Anything's possible. As I said earlier, I've been wrong plenty of times in my career, but betting on a soft landing to me is a real long shot.
Okay, so no soft landing, a hard landing is what he's expecting. But check out the interviewer's dangerous question about what we can expect in the future.
So you think once inflation goes above 5%, it's very hard to tame it in a way that's elegant?
Well, that's what history says. there's an interesting historical fact, which in fact I think is going to be violated, but two undefeated records are: number one, once inflation gets above 5%, it's never come down unless Fed funds have gotten above the CPI. Well, since the CPI is 8, that would call for a Fed funds rate of above 8. Frankly, I don't think we'll get there because the extent of the asset bubble and the damage that would be done.
If you caught what Druckenmiller said, he said that once inflation gets above 5%, it has never come down without the Fed funds rate being higher than inflation. And since inflation's at 8.2% right now, Fed funds rate's got to be higher than that. This is all a mess. And just for a definition, the Fed funds rate is the interest rate that banks charge each other to borrow money overnight. This affects mortgages and car loans and expansions for businesses. And the current Fed funds rate is 3.25. And need I remind you, inflation is at 8.2. So of course, with all this bad news, we're expecting a huge crash. But that's not the whole story, because today we also saw a huge rally. The markets rebounded. And so here we're at the chart again, and we saw the crash when the CPI reports came out. But after that, we saw a huge rebound here. We just saw so the market is totally rebounded and is doing well at 19.8. I personally bought a Bitcoin at $19,000. I was a little distracted. I was going to buy at 18.5, but I bought at 19,000 and I sold at 19,800 for a small profit. But I'm not upset because small profit is still profit. So the natural question is, why did the market rebound so strongly? And there's a lot of guesses out there, but for me, I personally think that there are a lot of people out there who are buy the dip people who wanted to wait for something like this to happen, just like me, and then bought in just like me and ran that thing up. I also found this article on Bloomberg saying why stocks swung 5% in one day. And this is, of course, in stocks, but it, I think, is obviously applicable to Bitcoin. And it says this: it's just the nature of the beast these days where sometimes you get these intraday big swings. We can all speculate on what might be behind it. A lot of it has to do with, a lack for a better word, the mechanics of the market, the fact that there's more short-term money in the market, there's more money that moves around based on algorithms, quantitative strategies, and at any point in time, you can have triggers that can cause a 180 in the middle of the day. So yeah, they're talking about like these triggers, these things where people have set in, we're like, okay, it's going up, boom, buy again, boom, 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 and it keeps going up. So what can we expect in the long term and what can we expect in the short term? Well, for a long-term perspective, I want to turn to Larry Fink. He's the CEO and chairman of BlackRock, which is an investing company, hedge fund, and he has a great perspective on inflation for the long term.
Inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now.
So by his assessment and by Jerome Powell's own admission that they are in it for the long term, this fight is going to be a long-term fight with inflation, probably not ending till 2024. But for the short term, and I'm talking in the next month or so, there are some important catalyst events, dates that you and I need to be aware of. November 2nd, the Fed will release their interest rate decisions. November 4th, there will be a jobs report. November 8th, there will be midterm elections. And November 10th, the CPI data gets released yet again. Here's my prediction, not financial advice ever, just a lizard brain cowboy trying to make sense of things. The markets will still continue its downward trajectory. Gasoline prices will still remain relatively low until November. After the elections, things are gonna crash and we're gonna be in this bear market for trading sideways for a very long time, maybe up until the middle of next year. These are some of my predictions. Let me know what you think down in the comment section below, and I'll see you guys in the next video.